20 years looking at people's finances, 20 years of helping people buy a home. I learned probably about 18 years ago, I don't just want to help them buy a home. I want to set them on a path for true prosperity over a long period of time, not just getting them a home. I want to look at everything. I want to look at income. I want to look at assets. I want to look at debt. A house is a cornerstone and a piece of true wealth, but it's only one piece. So it's easy just to get them a mortgage. I like to go a little further and talk about things that I've learned in my life, and I love to help clients with that with 20 years of experience. A lot of times people come in and say, I've got to put 20% down. And that really does make sense for some clients. But if a client has a lot of credit card debt, and we look at credit card debt being the highest it's ever been recently, we look at the interest rates moving up dramatically, it may not make a lot of sense to put 20% down when we can knock down some credit card debt at 16%, 18%, 22%. See, a house is going to appreciate typically in value in this market, 5% is conservative. Nothing's guaranteed, but I expect, in my opinion, to see 5 to 7% appreciation over the next several years of houses in our area. I really think that's going to happen. Get in, build some equity, let that run, turn around and pay off that other debt so that your overall household expenses are dramatically lower. It makes a big difference. What's also going to happen over the next several years, I believe there's going to be an opportunity to refinance. So even if a client's paying a little bit of money in mortgage insurance because they didn't put 20% down, guess what? They're not paying 24% in credit card debt. That house is appreciating in value. When we go to refinance, we can capture that new equity that was built over the next several years and get them out of mortgage insurance and get them to a lower interest rate. So I like to look at the full piece and look at the total everything with our clients when we meet with them. Let's talk about consumer debt, specifically credit card debt. If someone is incurring 24% interest, as an example, on a $5,000 credit card, it's $100 of interest every single month. The minimum payment is what? $100. So they're paying the minimum that's never going to get paid off. To apply the money to get that paid off, even using a lesser down payment, makes a lot of sense for clients. Get out of that debt. They're never going to pay that off. It's going to be very difficult to pay that off. So setting up a plan to knock that out, even if they're paying a little bit of mortgage insurance, even if their monthly payment for their house is a little bit more because they put less money down, they're able to get rid of that big debt that's lingering out there. I want to see every one of my clients have several months reserves. So if it costs $5,000 to keep the bills on, keep the lights on at your house, that's $5,000 for car loans, student loans, minimum credit card payments, mortgage payment. I want to see our clients with at least $15,000 of savings that's liquid. Life happens. Having those cash reserves are critical. And I love walking people through how to do that, how to get there, how to put money away. After we get that roughly 3-month cushion put together, I want to talk about increasing 401k contributions. Most clients should be putting more money into their 401k. It's easy just to do a mortgage. It takes another step to talk about how much money you're putting away. Let's talk about what that looks like over a long period of time. I actually have a website that I love and I'd love to share to talk about compounding interest and what they can do. And any consumer, go look at that. It's part of my presentation when I meet with most clients to talk about putting money away and what long-term retirement looks like. I'll pull that up. It's investor.gov and let's dig an example of what that looks like. So this is one of my favorite websites, and I use this often in presentations with clients talking about the eighth one of the world, compounding interest. Federal government website, it's investor.gov. And underneath here, you go to financial tools and calculators on the tab. And you drop down to the first one there, which is called Compound Interest Calculator. I like to use this, especially with first-time home buyers. Let's talk about someone just getting started in their 401k. And let's say they have $5,000 they put away in their 401k, maybe mid-20s, starting to put money away. And we're looking at what they're contributing to their 401k. A big mistake that a lot of people look at, they only put away the amount of money their company matches. I think that's a big mistake. We get compounding interest, whether the company's matching it or not. It is great to get that money in there. So in an example, let's say we can get a client to a position that they're going to be putting $500 away on a monthly basis in their 401k. At 25 years old, they have about 40 years until retirement. And past performance is not indicative of future results. I'm not selling anything here. The majority of the money that most clients should be using, and their first thing should be, is through their 401k, through their company. If they're with a government agency, I believe it's a 403. If not, an IRA. But I want to just share this. This isn't anything, a financial instrument that I'm selling or I'm promoting. I'm just talking about whatever it is. But for most people, the first one is their employer. So if we can put $500 away per month for 40 years at a 10% interest rate. 10% is an interesting, like, well, why 10%? I don't earn 10% right now. Well, some years when you're in the stock market, you could earn 20, 30%. Some years you lose. It's back and it's forth and it's up and down. With this client at 25 years old, they have a 40-year time horizon. Over the last 30 years and the last 40 years, the stock market has returned. S&P 500 standard funds have returned around 10%. So I want to use 10% as a number. You can play with this. You go to the website and say, what if I only got 5%? What if I got 12%? I like to use 10 when I'm calculating things out over a long period of time. In this example, this client at 25 years old, from just putting away $500 per month, will accumulate about $2.8 million at retirement at 65 years old, simply by putting away $500 per month, and done so for an extended period of time. What gets really fun at this website, if you go back up and say, wow, $500, what's going to happen with most people at 25 years old, at 35, at 45? Peak earning years for most people are in their 50s. So what should happen in your career, you'll continue to make more money as you go on in your career. If that's the case and you start moving money up, like, let's start putting away $700 instead of $500. Let's look at what $700 looks like over 40 years. It takes us up to nearly $4 million from simply a couple hundred more dollars a month. And the fascinating thing with 401k, finding $200 more may have been the difference of you taking home $150 or $140. But if you were able to put away $200 more a month and do so consistently for 40 years, that would net a result of nearly $1 million more from just a couple $100 a month. Eighth one in the world, compounding interest. Great site. Encourage you to use it, play with it.